how to reduce capital gains tax. Now, often when people are wanting to reduce the capital gains tax, it's in association with an investment property. They're approaching retirement and they're wanting to avoid having to deal with tenant issues and ideally putting money into the superannuation environment so that they set themselves up to receive or be in the structure that's going to provide them a tax-free income and also to maximise their Centrelink benefits. So the scenario often is that they've purchased a property, often a residential property, and let's say for example that the property in this case is worth $300,000 when they purchase it. And it has grown over time to the value of $500,000, and at that point in time they sell the property. Now if they sold the property for $500,000, bought it for $300,000, they've made a profit of $200,000. If they've held the property longer than 12 months, then that $200,000 is discounted by half, or 50%, to $100,000. Now, if you own that in your individual name, that full $100,000 would be added to you to your taxable income, and you'd pay marginal tax rates on it. If you hold the property in joint names, then the $100,000 is split between the two of you. That's what we're going to assume in this particular scenario, that the property was held jointly and the $50,000 is going to be split between two people. We're going to use Joe and Mary again. We'll stick with them with the example. And in this case, we've assumed that Joe earns $70,000 in wages and interest of $10,000. So his total taxable income in this scenario is $80,000. If you add the capital gain of $50,000 to his scenario, on that additional capital gain, he's going to pay a tax of $19,250. That's just the additional amount of tax on the gain, not his total taxable income. In the other scenario, so in Mary's scenario, we've assumed that she's not working, but she's paying, she's generating some income from investments. It could be rental income from the investment property that they owned of $10,000. If you add the capital gain of $50,000 onto Mary's taxable income, she'll pay tax of $12,150 on that additional $50,000 capital gain. So they've paid on the capital gain on the sale of the investment property $31,400. So how can you actually reduce that? Well, we're going to look at Joe and Mary separately. So in Joe's scenario, because he is employed, the only way that he can reduce his tax on the gain is by salary sacrificing. Now it's important that the salary sacrifice is done sufficiently early in the financial year to enable him to salary sacrifice the maximum amount. So we're looking at two different scenarios. If he does nothing, Joe's $80,000 plus the capital gain of $50,000 will mean he's got a taxable income of $137,000. So the total tax that he'll pay in that financial year is $38,000. Now if he made salary sacrifice contributions, so if he set this up early enough in the financial year that he's selling the property, he could salary sacrifice up to $43,700. It's not fully $50,000 because he's got superannuation guarantee contributions in there as well that he needs to make. So his salary sacrifice is $43,700. His taxable income then reduces from $130,000 to $86,300. His tax reduces from $38,000 to $21,176. He does pay some contributions tax that he didn't previously pay of $6,555. But his total tax now reduces by to $27,731 or a total tax saving of just over $10,000. Now in Mary's case, because she's not employed, she's able to make what we call substantially self-employed contributions. So she can make deductible contributions to her superannuation account. Now the requirement here is that her income from employment purposes needs to be less than 10% of her total income. And because she's got no employment income at all, she satisfies that requirement. Now, if she makes no deductible contribution, then she'll have a taxable income of $60,000 and pay the full $12,150 in tax. If she makes a deductible contribution of $30,000, it reduces her taxable income to $30,000, and she reduces her taxable or income tax paid from $12,150 to $2,550. She does have to pay $4,500 in contributions tax. That's 15% of the $30,000, but the total tax reduces by $5,100. So if we go back to the full scenario, we've reduced the tax on the capital gain from $19,250 to just under $9,000 for Joe, and we've reduced the $12,150 in tax down to just over $7,000 for Mary. So that's reduced the total tax on the capital gain down from $31,400 to $16,031. So we've made on the a total tax saving on the gain in this particular scenario of $15,369. So that's we've nearly halved the capital gain in this particular scenario. So what we've done was effectively reduce the capital gain on the sale of the investment by reducing our taxable income. In Joe's case, it's been by salary sacrificing because he's employed. In Mary's case, you can make deductible contributions to offset the capital gain. Now, the other thing you can consider here is that a way of reducing your taxable income, if you're thinking about selling a property at retirement or close to retirement, a strategy is to sell or work for a month into the financial year. So potentially work and for July, so the first month of the financial year, you've satisfied the work test. If you're over 65, or you've just worked sufficiently in that year to generate some income, and if you sell the property in that year where you've generated a low income, you've basically done what Mary's scenario has done, and you've set up a structure where you can actually make deductible contributions to superannuation. And so you've got a low income, you can make deductible contributions, and it's a very effective way to manage the capital gains on the sale of an investment. So that's how you reduce the capital gains on the sale of investments. There are a few things to consider when making deductible contributions to superannuation. So this is talking about Mary's scenario, not Joe's scenario. The contributions must be made in the year in which the capital gain is incurred. The contributions must be made to a complying superannuation fund, and the contributions, if you are approaching the 75 years of age, over 75 years of age, you're not able to make contributions to your super fund, so you just need to manage that. You need to have lodged a valid notice with the trustee of your super fund, and it must be acknowledged. The deduction must be acknowledged by them, and the person who's made the contribution must be entitled to make those contributions under superannuation laws. So just need to factor in, and also that 10% rule that we talked about before.